Hello, everyone, and thank you for joining us today. My name is Ulysses. I'm from Tay Kim & Associates CPA. Let's get started.
All right, let's jump in here. So HR1 stands for House of Representative Bill number 1. By now, we already know that this bill came into public law on the Independence Day. And currently, we're sitting in IRS and the Treasury Department to start writing some detailed guidance and tax instructions. But how is that going to get enforced? How is that going to be documented properly? And so, IRS kind of want to make sure that they're not setting themselves up for challenge here, right? If they're going to come out and audit, they need to make sure they set out the proper guidance and instructions to set in place to begin with. So that's currently in place. Now, there could be some revisions to the tax bill during this process. So everything that we're presenting today is the bills that are approved on July 4th. However, we may see very small revisions based on IRS guidance and the instructions, and anything that it has to make sense to bring to life. Okay, so the One Big Beautiful Bill Act. Today, what we're gonna do, we're gonna mainly compare pre-HR1 and post-HR1 changes. There are also a mixture of permanent and temporary changes. There are some tax reforms that will remain in effect permanently until the next bill comes in to replace it or modify it. And also, there are some tax bills that will stay in effect for the next 3 years or so, and it will expire. Some of you may have heard it, but there are some major changes that's happening in the renewable energy sectors. We'll go through that as well. And there are some new tax reforms introduced, some exciting stuff. So we're going to be covering that today. Now, there is a midterm election that's going to happen in November 2026. And not to put too much emphasis on this, but during that midterm election, if Democrat were to take the majority of the seats, they could introduce some revisions to this bill. So again, there are permanent and temporary changes that'll say 2026 and 2028 and into the future, but they could be subject to modifications. All right, so let's begin. This first chapter is about individual folks, all the tax provisions for the individual income tax. Okay, so the first one here is your tax brackets for the individual income tax. So the Tax Cuts and Jobs Act rate was supposed to be reversed back to, I believe it was 39% prior to I'm talking about pre-Tax Cuts and Jobs Act rates, not pre-HR1 rates, was supposed to be 39 and it expires in 2025. So starting 2026, we were all supposed to be jumped back into the higher tax bracket, but the HR1 renewed the Tax Cuts and Jobs Act rate. And so that is going to remain permanent, actually. It's not a temporary change until a new bill is introduced and approved. So now that is set in place. So huge relief for many of us for planning for our future. Now we're talking 2026, right? Because 2025, your rate for TCJA is still in effect. Okay, so our standard deduction is also renewed. So the standard deduction also was supposed to change after TCJA expires in 2025, but it's going to remain the same with some indexed increases with respect to the inflation adjustments. So for 2025, your single and married filing separately, folks, your standard deduction is $15,750. For the head of households with dependents, it will be $23,625. Married filing jointly will be $31,500. Some insights here. So there's a permanent and enhanced standard deduction provides it provides a significant tax relief. Obviously, your standard deduction will remain the same. That's a pretty good tax break for many of us. Okay, so the next part here is child tax credit. So TCJA were to be expired after this year, and it was supposed to go back down to $1,000 per child starting 2026, but that got renewed and it is set in place permanently. Now, for 2025, your child tax credit per child is going to be $2,200. So we all got additional $200 per child. And then going forward in the future, this credit will be adjusted based on inflation. Okay, now we have other dependent credit. If you're claiming anybody, such as your parents, grandparents, that you're caring for them in your tax return, we all received a good old $500 per person. Now that is going to be renewed. It was supposed to expire and we don't get that credit, but it will be renewed and it is currently set in place permanently. All right, so this is a very fun topic here, estate and gift tax exemption. Um, Tax Cuts and Jobs Act back in 2017 really set a milestone for people who are considering giving a large sum of a gift to the family members or even to other folks. Previously, the gift tax and estate tax exemption threshold was somewhere around $5 million and so. And so this exemption is allowing people to give gifts up to that amount without thinking about gift tax considerations. So in this example, it $13.61 million for 2024. If you end up giving $14 million of gift to someone, then your taxable portion of the gift is approximately $0.4 million, $400,000. So that was for many people, this probably will not be applicable, but it just got even better. That went up to $15 million. All right, so this TCJA 13.61 million is set in place to expire in 2025, and it went up to 15 million flat, and it's 15 million per person. So what I mean by that is for single filers, it's $15 million. If you're married filing jointly, it's $30 million. Another one that I want to add to this is there is an annual gift exemption that will not get counted towards this $15 million. And we all heard about this way back. It was 14,000, 15,000. And it's been gradually climbing up. As of today, in 2025, we're sitting at $19,000. So you can give $19,000 to a person without that being counted towards this $15 million exemption threshold. $19,000 can be per donor and per recipient. So if I'm married with my wife and I have 2 children, I can give 19 to my child number 1, child number 2, without them being counted. My wife can give 19,000 to child number 1 and child number 2. So there are 4 $19,000 that can be given as a gift without them being counted towards this estate and gift tax exemption. So for the most part, it's really, you don't really have to worry too much now that the threshold has gone up significantly. Okay, so mortgage interest deduction. Now, Tax Cuts and Jobs Act, prior to that, if your mortgage balance was more than $750,000 principal, you can deduct all the interest on it. Now, TCJA set a limitation to it. And so if you have a mortgage with a principal balance of more than $750,000, the interest on the excess of the $750,000 principal is not deductible. So there was a limit to that. And apparently that change is still here and it has been renewed permanently. However, there was one new thing that was introduced here is you can now deduct the PMIs, the mortgage interest premiums that you pay. Because back in 2017, TCJA disallowed the PMIs to be deducted, but now it is allowed starting 2025. All right, so next part here is home equity loans here. TCJA set to disallow the home equity debt on the money spent on the non-home improvement activities. Let's say you got a home equity loan and went to Hawaii or something, right? So that the interest on that home equity debt is not deductible in itemized deduction. So that rule is now set in place permanently. Okay, so miscellaneous itemized deductions here. There was a lot prior to TCJA, there was a lot that people were able to deduct in itemized deductions. Sometimes I have a client that gives me like a security deposit box in your bank. Those fees, you were used to be able to deduct those. The tax preparation fees, and a few minor items such as unreimbursed, like if you had to wear certain uniform for your job and you were not reimbursed, you were able to deduct those items. And also some of the home office deductions, even though you're a W-2 employee, you were able to deduct them in your itemized deductions in the miscellaneous section. Now, TCJA started to disallow those items. The work-related uniforms is only allowed to a certain number of professions, such as firefighters, law enforcement, and military folks are able to deduct those out-of-pocket expenses unreimbursed into this miscellaneous item. So you're still able to do that, but a lot of the home office, the security deposit boxes in the bank are disallowed. And so that change will be here permanently, and it's not going to change anymore until the new bill is passed. For educators, if you're a teacher, you probably have been deducting $300 of out-of-pocket educator deduction expense. Now, the HR 1 did in this bill is it added a little bit more into the definition of educator as to not only limit to the teachers who are involved in the school district, but also the coaches. And one of the things that's not included here are also like the daycare providers. And if you're just hired to provide childcare work for some other families, you're now in that category as well. So you can deduct out-of-pocket expenses up to $300. Okay, moving expenses. Prior to TCJA, we were able to deduct moving expenses out of pocket. That is no longer in place since 2018. And so that limitation is currently set in place permanently by HR 1. Now, as you can see, there are some exceptions here for armed forces and also intelligence community. I think these are more like, the law enforcement folks who needed to get relocated. The military folks, if you need to relocate, then that deduction, that moving expense is deductible, and you can continue to deduct that in the future as well. Wagering losses. So this is gambling here. And so pre-HR 1, currently, what's happening here is if you lost money more than your winnings, you can deduct your losses up to the winning amount. And the way this works is you record the gambling winnings in your total income that will get counted towards your adjusted gross income. And then in your itemized deduction schedule A, you'll deduct the gambling losses to offset the AGI to arrive at your taxable income. So just be very careful if you're walking into a casino. If you end up with a high winning, your AGI, adjusted gross income, will still remain high, even if you lost all that money, because those losses are deducted after the AGI to arrive at the taxable income line. You're not paying tax on it. The reason why I bring this up is a lot of the benefits that we apply for or any type of loans type of situation, they look at the AGI number, adjusted gross income, especially the Social Security Administration. I have a few retired clients here, and for a miraculous reason, you won a jackpot or something, you have $1 million, but you spent $2 million. Now your AGI will be higher by $1 million, even though you lost all that money, because the deduction is happening after the line to arrive at the taxable income. So just be very careful and in doing that. It's a very, very bad situation where you lose the benefit, but then you also lost the winnings. on the gambling. Now, going back to the HR1 changes here is now you're able to only deduct 90% of total losses. So this is only a problem if you spent $100,000 in gambling and won exactly $100,000, then you can only deduct $90,000, and you have to pay tax on the difference of $10,000. However, if your loss is way more than the 100, let's say $150,000, so then your loss is 135, that's 90% of the 150, but your winning is only 100, then your limit is 100. So you don't report excess loss in that case. But again, this is only a concern if you lost exactly the same amount of the winning. Now, HR1 introduced charitable deduction provisions for two different areas. One for people who are filing standard deductions, and the second, people who are using the Schedule A itemized deductions. This particular part is for standard deduction people. So now you may recall back in COVID period where you were allowed to deduct $300 regardless if you're itemizing or not. So that is now coming back in place. So the non-itemizers, people who are using standard deduction, they can now take $1,000 maximum of donations that you can deduct for single filers and $2,000 for married folks. So that's a very good cherry on top. I personally really like it. Now you can tap into this provision here and still deduct your donation expense, and it will reduce your taxable income. Just make sure to keep a good documentation of your donations. Be very careful when you're donating money with loose cash at a church with a basket going around or any of that situation. Just make sure to have some documentation. And nowadays, the church organizations can provide a written documentation for you, even if you give a loose cash. Just make sure that you communicate to them about that. Okay. Okay, great. So here is the itemized folks here. Now, if you're itemizing your tax return, Schedule A with mortgage, interest, property tax, and all that good items there, you have to contribute at least 0.5% of your adjusted gross income in order to be able to deduct these donations in your itemized deduction. So in my example, I'm going to say your adjusted gross income is $100,000, then 0.5%, so that is 0.005, is $500. So if you're making $100,000, you have to contribute at least $500 in order to deduct it in your charitable contribution deduction. If you donate $400, you're not going to be able to deduct that, but that $400, the shortage, will be carried forward into the future year and will add and let's say you donated $400 next year too, then you have total $800, then you can take that deductions there. So it's not entirely going away, so don't feel bad if you donate too little. It's still going to be there until you use it up in the future. All right, let's shine some spotlight on this one here. No tax on tips. How good is that? How it's hard to believe. So there's a limitation here. If you earned a lot of tips, you can only deduct up to $25,000 of your qualified tips, and I'll explain a little bit about what qualified tips is. So we're talking about the restaurant folks, the servers, the chefs, and the hospitality department who regularly receive tips for their labor will be able to deduct up to $25,000 of their tips received in their tax return. So there is a limitation if your modified adjusted gross income is more than $150,000 for single filers, or also merit filing separately filers, or $300,000 for joint filers, then you will not be able to deduct this exclusion. And so the tip income it's going to be a deduction. It's not an exclusion. So what I mean by that is you still need to report all of your tip income into the AGI line. If you're getting a W-2 from a restaurant, on box number 7, it'll say tip amount there. You need to report all of that number. And then after the AGI, there will be an adjustment line, other adjustments. So then in that line, you will be able to subtract or deduct the tip income up to $25,000. The current provision says the employees, the taxpayers who are opting in to deduct their tips should request a written copy from their employer to say, hey, in 2025, your total tips income was $30,000. Then that's your support. And so make sure to keep some kind of a written support from your employer. Okay, our next pretty interesting topic here is no tax on overtime. First of all, this is for the non-exempt folks. It's going to expire in 2028. Now, you're allowed to deduct up to $12,500 in the same manner that you deducted the tip income into an adjustment line there. And there are all obviously limitations for highly compensated folks. Then you cannot deduct the overtime pay. And also this ends in 2028. And this is only available to people who have active Social Security number, not the ITIN number. The limitation on the income is the same as the tip exclusion, is $150,000 for individuals, single filers, and $300,000 for joint filers. The overtime, this is another provision that is work in process by IRS and the Treasury Department, is they're working on whether disclosing a separate box to show the overtime pay on the W-2 or 1099 in this situation. And this is a huge concern here at the moment because our W-2 form really, the format of the W-2 hasn't been changed for a very long time. And so making that change and implementing the change, especially for the small business owners, it's going to be a big struggle. And so for small business owners, if you do have employees that you're paying overtime payment, you need to make sure that you keep a good documentation or talk to your payroll providers so they can help you disclosing that number into the W-2. Okay, so there are some tax provisions here for seniors. This temporary rule was introduced and is approved is to allow seniors to receive additional $6,000 in so-called a senior deduction, is a new section 151 that was introduced. If your income is more than $75,000 for single filer or $150,000 for joint filer, this $6,000 bonus deduction, it will be phased out gradually. All right, so here is a new tax provision here that was introduced for individuals. Now you can deduct your auto interest, your car loan interest expenses in your itemized deduction. Now, this here, we're not talking about business cars. We're talking about individual personal cars here that you drive on a daily basis for personal use. There are some regulations on this that is set in place. One of the main one is the vehicle must be manufactured and assembled in the United States, and the original use must be the taxpayer. So if I bought a car for my dad out in Georgia, well, I can't deduct it because I'm not the one using this vehicle. So you just have to make sure you keep an eye out for that. For the most part, I think a lot of us won't need to worry about that type of regulation. Also, if you bought a car for your children that you're claiming as a dependent, you can definitely deduct the auto loan interest on your itemized deduction. The limit is $10,000 per year, not per vehicle, but it's per year. So you can only deduct up to $10,000 in your itemized deductions. You have to have paid the interest or accrued the interest after 2024. So if you bought a car in 2024 or previously and you're currently paying the car loan right now, that is not deductible. So these are only applicable to the vehicles that you purchased in 2025 or on forward. Then you can deduct the auto loan interest. This is also, there's a limitation for high income earner. If your income is more than $100,000 for single, $200,000 for married, deduction on the auto loan will be phased out gradually. All right, so this is kind of a hybrid in between the business owners and also the employees. Pre-HR1, there was a deduction that the employer can take to provide some assistance to pay off the student loans for their employees, and they can deduct up to $5,250. And now that that rule were to be expired in 2025, and that is currently set in place permanently. One of the main parts that you need to be careful with student loan interest that the employees can deduct in your personal tax returns. You need to make sure the interest portion that was paid by the employer is not double counted in the employee's portion of the deduction. And so if the lender doesn't know what portion came from the employer and what portion came from the employee, then it is the employee's responsibility to make sure that you offset the interest covered by the employer under the Section 127 exclusion. Okay, so adoption credit. Now, prior to HR1, there was an adoption credit that a lot of the parents could receive, but it was a non-refundable credit. What non-refundable credit means is it will only reduce your tax liability, but if the credit is higher than the tax, they're not going to give you a refund. They're going to keep that money and carry it into the next year until you use it against more tax in the future, just like the solar credits were. Now with the HR1, this adoption credit is refundable up to $5,000. So if your credit is more than $5,000 that you expect to get in excess of the tax liability, then those additional numbers will be carried into the future year as well. All right, 529, great. So this is another great part here. So the way this works is you can contribute to your 529 plan for your kids, and you can use that money to pay for college tuitions. And pre-HR1, you can spend up to $10,000 on K-12 tuition expenses. What HR1 did now is it just expanded the definition of what gets counted towards the education expenses. And now you can use homeschooling expenses, post-secondary credentialing expenses, some activities, other extracurricular or tuition activities. You can deduct, use this 529 money to pay for those. And so also, if you have some kids who are interested in signing up for CPA exams to study for it, you can use the 529 money to pay for those exam study materials. So you can use the 529 to cover that. Sometimes your kids don't end up going to school, or they just don't spend money in these the college or tuition related expenses, and that money just sitting there. And so a lot of the people found it quite wasteful that you planned all these years for the 529 to just sit there and not being used up for what you intended for. So IRS introduced a new plan for taxpayers. Is if the money is not being spent and it's just sitting there for at least 15 years since inception, the beneficiaries, now my children, they can roll over the unused 529 funds into their Roth IRA accounts, which is a very, very good thing to do. And they can do it up to $35,000 during their whole entire life. So if you have a 529 balance of more than $35,000, then you can only roll over 35 grand, and anything more than that, then those amounts really need to be used for tuition expenses. Or if you use it for non-tuition expenses, then they're subject to a penalty. So that's the limitation there. And another limitation, beneficiary, every year when they roll over, that's subject to their $7,000 per year limitation. And they need to be able, and they must have the earned income to participate in this rollover. So I want to just remind this to all of you. If you have a 529 plan sitting there with balance that's not being used with your kids, 19, 20 years old already, go ahead and start rolling over into the Roth IRA account. Okay, great. So here is a new provision here, but they call it the Trump accounts. And so starting 2025, this new account will be introduced. This account will be treated very similarly to the normal IRA account, individual retirement accounts. However, this is for the young folks, your children, to utilize to pay for major lifetime expenses during their the youth during their lifetime, such as wedding or buying a house or any of those major events that they do. They can now, or I guess the parents can now plan ahead now this year until when your kids get married or any events happen, then you could withdraw from the account and pay those expenses. So now the way this works is you cannot touch the balance until your child turns 18 years old. And after that, then you can withdraw the balance to pay for the expenses. Now, every time you withdraw, because this is an IRA account, not a Roth IRA account, when you withdraw the money, that withdrawal could be subject to a normal income tax to the beneficiary. So that's just one part that you need to be careful with. There is a limitation for contribution. It's $5,000 per year. So the way the limitations work is when your child is born, or I guess when the Trump account is created for your child, you cannot contribute for more than you cannot contribute to it within the 12-month period. So you have to wait at least 12 months, and then you can start contributing $5,000 to your child. Okay, and again, this is a deferral contribution, tax deferral contribution, because this is an IRA account. And also for children born after January 1st, 2025, this current year, and before December 31st of 2028, you're gonna get $1,000 tax credit for each child to open this Trump account for your children. And now the way this works is they're not gonna open a Trump account and put a money in there for you. What they're gonna do is in your personal tax return, if your child is born, you're gonna receive an additional $1,000 and in your tax credit. So the parents will end up with additional $1,000 in their bank account. Then they're gonna go out and contact Vanguard, Fidelity, or whoever brokerage firm that they're using and open this Trump account under your children's name. And then you can park this $1,000 in there for your kids. All right, this is another big change here. So SALT cap. So SALT stands for state and local tax deductions. If you look at your itemized deduction, Schedule A, there is a section where you get to deduct your tax items there. Property tax, sales tax, local state taxes. And we all know that limit is $10,000 currently. And starting 2025, that limit will go up to $40,000. This is a permanent change, so it'll stay in place and it will continue to rise based on inflation. Over here it says increase by 1% all the way to 2029, and after 2029 in 2030, it'll be reversed back to the $10,000. So we just have to be very careful in future planning on that. Okay, so next part here is energy tax credit provisions. We're gonna be talking about this. Some of these provisions are applicable to the individuals, the personal tax return folks. So stay tuned on this one here. Okay. All right. Next page. Okay. So let's start off with this here. We put together a table for you with the dates that will be terminated. Not all of them will be happening all at the same time, as you can see. All right. So our first item is Section 179(9)D. This one is for commercial buildings deduction. If you're a developer, if you're a real estate investors, they used to receive the tax credit for installing energy efficient and solar products onto their commercial buildings. That credit will expire on June 30th, 2026. Now, the way this works is as long as you start the construction by June 30, you can still claim this tax credit here. Okay, so this one here, Section 25C, is not a solar panel, but this is energy efficient home improvement credit. So what this really is if you're installing energy efficient windows, doors, new roofing system that helps your house to be more energy efficient. Those items were receiving a tax credit up to 30%, and it's not a lot. It limits at $1,200. And it's interesting to say the pre-HR one, it was a permanent, well, I guess it was somewhat temporary that it was set to expire in 2032. Now, HR one kicked in and it changed that expiration date sooner now that this will expire in 2025. So we have about 4 months or so if you're looking to make some improvements for your house, new windows, new doors, new roofing, and there are some very small few more items such as insulation products, some of the quiet, cool, the whole house fans type of thing are one of those items that you could consider. So if you're looking to make those purchases, you might want to look into doing it prior to December 31st so you can receive some tax credit on that purchase. Now, if you have a house, if you have a big house, you can also bring an engineer in to audit your house. And the engineer will say, all right, here's a full written report. If you do this, you'll be saving how much in energy bill. And so they audit everything here and they present the cost and everything there. That audit expense to the engineer is also subject to this 30% of the efficient home improvement credit that you can look into. But that will expire this year on December 31st, 2025. All right, so this is a main topic here, Section 25D, the residential clean energy credit. So this is the solar credit, mainly speaking, along with the various other items. And so there were no particular limitations to this, except that you're receiving a clean 30% of your solar panels and battery packs, geothermal heat pumps. You know, some houses have those the solar water heaters. Those are super cool items there. Now these items will expire by the end of this year. All right, the next page here is Section 25E. And so this was somewhat complicated tax credit that gave tax professionals like myself some extra energy that we needed to put in for our clients to make sure that they receive this tax credit because the conditions were very strict. Long story short, if you're purchasing a used energy clean a clean energy efficient vehicle such as an EV, that tax credit is going to expire on September 30th, 2025. So you have about a little less than 2 months if you're considering purchasing an EV, a used EV to be specific. That credit that you need to make the purchase prior to September 30th, 2025. I want to explain to you briefly on how to claim a used EV tax credit. Make sure you review this before making the purchase. First of all, if you pay more than $25,000 on a used EV, you cannot claim the tax credit, unfortunately. So make sure you watch out for the purchase price on that. Now, that purchase price does not include the sales tax, the DMV registration fees. Some of these dealerships install those GPS trackers on the cars, and they charge a ton of money for it, actually. But really, we're looking for a top number, gross sales price. If that is $25,000 or less, you're good to go. And also, if your car that you're purchasing, it has to be 2 years or older than the year purchased. To make an example, let's say you bought a car this year in 2025. This used EV, the manufacturing year should be 2023 or older. Your GVW, your gross vehicle weight should be under 14,000 pounds. The next topic you need to worry about is you cannot make a private seller purchase. In order to take this credit, you have to purchase from a registered dealership or registered auto sale I don't know, person or company, but it has to be a registered seller. The reason for that is every single dealerships that sell these EVs are now required to report the sale and the tax credit to the IRS. And so you probably, for those who purchased an EV in the past year or so, you may recall receiving a letter from IRS saying that you need to file, include this in your tax return and all that. The reason why you got that letter is because your dealership is required to report that information to IRS. So make sure to purchase it from the registered dealership. There is an income limitation. If you're single, your income is $75,000. If you're married, it's $150,000. If you're a head of household with dependents, it's $112,500. So the qualifications to receive the EV credit is very narrow. Now, long story short, this is going away in September of 2025. So just keep that in mind on this one here. Okay, great. So here is a clean vehicle credit. Now this we're talking about a new vehicle, new Tesla or new EV that you're looking to purchase. That will be terminated. The deadline is the same. So that is going to be September 30th, 2025. So be mindful here. The solar credits on your house, that's year end. EVs, that's September 30, 2025. Okay. So some of the limitations here, battery capacity at least 7 kilowatt hours. The weight should be under 14,000 pounds. Final assembly needs to be done in North America. And there is also some requirement about the minerals that is harvested in the battery. Apparently, they harvest minerals to put in the batteries. That harvesting must be done within U.S. and U.S. Affiliated islands, I believe, like Guam or that area. But for the most part, if you purchase the vehicle from the dealership, they are required to give you a full assessment and to let you know whether this vehicle is qualified for you to receive a tax credit or not. Okay, so that I think you don't have to worry too much about it. There are some purchase price limitations as well. I believe the Tesla Cybertrucks and some of the SUV purchases on the EVs, the MSRP cannot be more than $80,000. And I think that's why Cybertrucks are being sold $79,999. That's the last time I checked, that was the sales price. So just make sure you check with the dealership prior to making the purchase and get some confirmation that you will be getting the tax credit. Okay, great. So now over here, if you're looking to purchase a clean vehicle, I believe there are some of these like a Ford EV vans that you can purchase under commercial use. The Section 45W is here. That will also expire on September 30th, 2025. Okay, so we're going to jump into business income tax provisions. And this is the part where we're going to focus on the HR1 tax provision applicable for the business owners. Great, so if you are a either sole proprietor, LLC, S corporation, or even a partnership, if you have an earned business income, you are subject to receive a 20% discount on your pass-through income. And don't get too confused about pass-through situation, because technically every time me as a business owner picks up the tax burden on my business, that's considered a pass-through income. So TCJA was set in place to offer 25% reduction on the business income. And so if I made $100,000 in my business income net, then I'm gonna get a discount. So the taxable portion of the business income is $80,000, which is great. Now that is going to stay permanent. That was supposed to be expiring in 2025. In 2026, you won't have that anymore, but this will be renewed and is set in place permanently. Obviously, there are some income limitations, and so it's subject to phase outs. Okay, all right. ERC. Oh my goodness. This employee retention credit has been a nightmare. The problem here is there are ERC retention credit service companies that was created during COVID period, and these businesses never existed in the past. And all of a sudden, these companies come in and they make a lot of sales calls, and they say, hey, you know what? We can help you get 20, 30, $40,000 of ERC credit. Just cut us, just give us a 10% of that credit to cover our fees. Okay, the IRS calls it ERC promoters. That is not my language, but that's the language from the IRS. So these ERC promoters don't have any type of regulation that they need to follow. Now, ERC promoters did not have a clear due diligence to follow. So these promoters are running out everywhere because they don't have to follow any rules. They go in, put together an application, and submit it to IRS and receive 10% of the credit. So to them, it's an easy money that they receive while not doing a proper job for the business owners. Now, these business owners received a huge amount of employee retention credit later only to find out that these ERC promoters didn't do a full due diligence to meet the requirement to receive the ERC. And later on, IRS started sending out these notices and letters to the taxpayer saying, hey, you received $40,000 of ERC tax credit when you did not meet the requirement. And the requirement is very, very complex. You have to compare the quarters from pre-COVID to after COVID, quarter by quarter, and then you request of the tax credit, and you have to amend the payroll tax return and the income tax return. And there's a lot going on here. So taxpayers end up with a tax bill for IRS asking for their money back of $40,000 in my example. Well, hey, I already paid $4,000, 10% to this promoter. Now I gotta give you 40 grand. I mean, that is the worst situation. So there has been a lot of cases that opened up with IRS, a complaint against these ERC promoters. And these ERC promoters kind of winded down as of today. But IRS is spending a lot of time and money right now in going after these ERC promoters. But we all know IRS, they're busy and they're very behind with a lot of the things that they need to do already. So I don't know how much of these ERC promoters will really face judgment, but it's a sad story. And so what happens here is any claims that you submitted after January 31st of 2024, so that's more than a year to the past from today. IRS will not receive it. They're gonna put a hold on it, and then they also put a heavier enforcement for the bad actors, so to say, on these ERC promoters who kick in and took the money really, and now these taxpayers end up with money that they need to give back to IRS. Some taxpayers don't even know whether they qualify for ERC or not on the ERC that they received. So that's another concern here too. So IRS also issued a statement sometime last year in 2024 that if you're a taxpayer and you found an error or you found that you did not qualify for ERC, but you received it due to these bad actors, and you raise your hand, you say, hey, IRS, I'm going to give you my money back. I found some errors here. If you voluntarily do that, IRS will waive the penalty and the interest on the balance due. So that's kind of a status right now. So the claims for the ERC, if you later, as of today, let's say you found out, oh, hey, I should have filed a claim or I should have filed an application to receive the tax credit. but I still haven't. Unfortunately, you have missed that window. All right. So this part here is on the employers. So if you have employees with children that need childcare, daycare expenses, and etc., you received a business owners or the businesses received a tax credit up to $150,000. And now HR1 is introducing an increase to that credit from 25% to 40%. And also, if you're considered a small business, then that credit percentage is 50%. And also maximum you can deduct is now $500,000, $500,000 from $150,000. Okay, all right, let's talk about 1099s here. $600 for the whole year. If you pay someone for a service, and the rule is actually quite strange. If you paid using a credit card, you don't have to send them a 1099. If you pay to a corporation, you don't have to send them a 1099. But if you pay to a single member LLC, partnership, or an individual, using Cash Apps, Zelle, Venmo, PayPal, Apple Cash, XYZ, or you wrote a check, you gave cash, any of that counts here for a trade for in return for a service received, not for a sale of a product, but a service received, then you need to issue a 1099. That is a current pre-HR rule that the business owners needed to follow. Now, the post-HR rule, now that it raised the $600 limit to $2,000 during the calendar year. Not $2,000 per payment, but $2,000 for a whole year. So, and also this provision is going to happen next year in 2026, and it will be enforced in the tax return for 2027. So now for the business owners planning for this for 2025, you can continue to send out 1099s using the $600 threshold, but next year you can raise it to $2,000. So hopefully the number of 1099s you send out will be less. Now, just to remind everybody, just because you did not receive a 1099 doesn't mean it's not an income to you. Even if you had $350 income, but without a 1099, you still need to report that into your tax return because that's what tax law says. Okay. One more reminder I want to tell all business owners. Today is August 7th. You have a few months left until the end of the year. I personally find it very, very easy and efficient for business owners to collect W-9 information before starting work, before hiring someone. So make it a process within your implementation before bringing on someone for a contractor. Hey, before paying you my bill, give me a W-9 so that I can give you a 1099 at the end of the year. So make sure that communication is clear and timely before you pay the money, okay? All right, so paid family and medical leave credit. And so this was supposed to expire after this year, and this tax credit is going to be renewed and it will be set in place permanently. And also, let's see here, it says insurance premiums modifies aggregation and eligibility rules. So what this means is Section 45S allow the employers when they pay for the employees when they took some time off for medical leave or paid usually moms and dads taking some time off after their newborn is born or any other personal medical. So just make sure you have proper documentation. Make sure those events were actually happening. I mean, you don't have to get birth certificate or any of that situation, but as long as there are some like doctor's visits and those type of thing, then you could continue to use this deduction here and receive tax credit for it. And so this tax provision is set in place permanently. All right, R&D or R&E expensing here. Now, don't get confused. This part is not about R&D credit. That's a separate topic, but research and development, research and experimental tax credit that we all know about is not changing, is still in place. And so that is going to remain in effect. And it doesn't expire. Now, this provision here is particularly about deducting or expensing the R&E expenses. Previously, the way you would deduct this, let's say you spend $20,000 on research and development of a certain product, the way you expense this is you expense $5,000 on the year that you pay the 20 grand, and the remaining $15,000, you're going to divide that up over the next 15 years evenly. And so that was a previous tax provision. Now, new HR1, it says you can deduct the whole $20,000 if you paid it after January 1st of 2025. And if you paid any R&D expenses to foreign entities, non-US entities, sometimes you hire folks out in India or outsource some jobs to do some research work, then it still remains the same 15-year amortization rule here. So now you're able to kind of accelerate that expense a lot sooner. Okay. There's also limitations as to the total amount of R&D expense that you can deduct all in 1 year, but really that limit is very high, and I highly doubt not many of us will really be facing that limitation. Okay, great. Well, here's another fun thing here. I feel like every time someone says bonus depreciation, we got one group of folks here arguing, oh no, XYZ. We got one group of folks here, like some social media folks are very excited to promote the bonus depreciations here. Okay, but keep in mind, bonus depreciation is bonus depreciation, but it's not really a bonus. I think that language is misleading. It's accelerated depreciation, right? Because you can only depreciate the total amount of money you pay for it. Now, pre-HR1, the bonus depreciation was 80%. So what that means is you can deduct 80% of the purchase, and then you'll depreciate the remaining 20% over the depreciation period. Now, next year, it was supposed to go down to 60% and gradually expire after that. However, HR1 introduced a complete restructuring of the bonus depreciation to bring that up to 100%. And I believe that 100% was back in 2017 with the TCJA. And so this 100% is renewed, and it's going to stay in place permanently until a new bill is introduced. This 100% bonus depreciation is going to phase down like it did in the past, and now we end up with 80% currently. And so this 100% will gradually phase down. If you bought a vehicle on January 5th or any of the days before January 19, 2025, you are still subject to follow the previous lower bonus depreciation percentage. But if you make the purchase after January 19, then you will still then you are able to receive 100% bonus depreciation. Section 179. So a lot of people get confused in between bonus depreciation and Section 179. Section 179 is not a bonus depreciation. So when people say Section 179, that they're not talking about bonus depreciation. What Section 179 is it sets a threshold of total depreciation on accelerated depreciations that you're taking. We're talking special allowance, bonus depreciation, and any different modified or accelerated depreciation that you take will get counted up towards this limitation. And if you exceed that limit, then that have to be depreciated over the future years. Now, Section 179 limit was $1.1 million. pre-HR1. Now that is now raised to $2.5 million per year. So if the purchase of your property is more than $4 million, then your deductible portion of the Section 179 limitation is going to be phased down. Okay. The reminder here that I want to set for our clients is the recapture rule that is set in place regardless of what HR1 says. And just be careful with this is because the recapture rules will be triggered when you either sell or get rid of the business property. And one of the most common property that has happening a lot is our cars, our vehicles. Vehicles break down all the time. You have to change your vehicle. You just want to get a new car for no reason. So the recaptures kick in, and what recapture does is it looks at all of the depreciations that you've taken in the past, and on the year that you sell your car, you're going to receive an income of the same amount that you depreciated, even though you didn't make any money off of it. So you purchase an $80,000 vehicle and depreciate the whole thing, and in the future, in year 3, let's say you sell the car for $1,000, but in your tax return, you have an $80,000 income from the recapture happening because you got rid of the car or sold your car that year. So this provision is still here, the recapture is still here, and the properties subject to the recapture, they're mainly Section 1245 property and Section 1250 property. 1245 is normal equipment, machinery, vehicle. Section 1250 property is your real property. Okay, charitable deductions for corporations, not for LLCs, not for S corporations, but only for C corporations. If you are a C corporation, you're allowed to deduct 10% of the corporation's taxable income to charitable deductions. So that's a great thing that the corporations can do. That is still in place. It is still taken in place permanently, but there is now a floor introduction, which means if a corporation's taxable income is $1,000, then you need to contribute at least 1% of it, $10, in order for a corporation to deduct that charitable deduction. Okay. And any of the unused portion below the 1% can be carried forward to next year to add to the 10% threshold. All right. Okay, that's all of our slides here that we talked about on the HR1 bills. There's a lot of little details that's taking in place in between, but I believe these are the ones that's really going to make an impact on all of us as a business owner and also as the individuals. Thank you, everybody. Have a blessed day. Have a blessed rest of the week. And I look forward to our next session. I'm sure there will be more opportunities in the future. Thank you, David, for joining us. And thank you, Ulysses. Have a blessed day, everyone.